Hello, once again, another exciting episode of Awakening Happiness. Good morning, Desi.
Hi, Chris. Good morning, everybody. I'm glad that you're watching this episode because it's not it's not financial advice,
Just reading
but
the
it is
title.
going to be some very interesting
Well,
discussion going on here.
well, yeah. If you like these videos, or you just joined, then click the like button and go on and subscribe to the channel and tick the bell thing to say that you'll be interested to get future episodes as we post them. So, what is this all about then? This is not financial advice. Well, it isn't because it's just a view and an opinion. But we're living in some pretty exciting times, and as Simon Dixon, who is also not giving financial advice, but he's basically wrote a book back in 2009 which said, protect your money before governments and financial institutions go bust in the big 2020 depression, which he wrote in 2009, 2010. So that was a bit of a forecast because, right
Mm.
now we look like we're heading into quite difficult times, especially around the world with all the war and the side and the different sides that are being constructed before our very eyes. And the interesting thing is that you look in the history books, and this is interesting too. I mean, it's not really the subject of this podcast, but like we read history books and we almost take them as gospel, and yet we know that what's going to be written about the pandemic is it was as bad as Spanish flu and all this, and yet we lived through it, and we know that's not true.
Well, actually, some people might say it was horrible
Yeah, no,
because that's what their reality was.
I
For
know,
us,
but
it wasn't in any way different. It was actually quite nice because I learned how to cycle through the roads.
I know, but like, what will be in the history books?
Oh, in
It
the
was
history
terrible.
books, it will be the terrible thing of the 2020 and then 2021 and then the repercussions of it.
And
Oh,
yeah, like if you were reading the history books about Spanish flu and you lived through it, what would your viewpoint have been? It's nothing probably like what the history books say. So so you've got to question everything, including the history. And but like right now, because of all this stuff and the general appreciation of the situation and all the people that the media and everything else is promoting about the pandemic and subsequent fallout, we find ourselves in a situation where now it looks like America, for example, at war, not directly, but through NATO, a war which is a defensive, protecting, not an aggressor, but it looks to me like they are also aggressors. But basically, they've got a war going on in Russia. They got a war. They want a war with Taiwan. Well, not war with Taiwan, but protect Taiwan against China. Although China's never said they're going to invade Taiwan. So you got an issue with maybe putting sanctions and a war against China, and then you got them trying to saying, "Oh, Mexico's a problem. We're going to go there." Haiti. It's like there's about 20 odd wars going on at the moment. They're involved in, and all of this, and it brings me on to the subject because all of this in a world where like America's got 31 trillion in debt. 31 trillion, not billion. 31, it's like 1,000 million. 1,000 billion is a trillion. 31 of them. It's unbelievable sums of money,
can't
right?
even imagine what that number
Can't
is.
even imagine. And what they're doing is they're throwing money at the defence budget, like another trillion on defence. They've just and like they haven't got any money. They haven't got any money. Where is this money coming from? It's like it's unbelievable. It's like they're just printing it up and just manufacturing it out of nowhere most of the time because jobs are going down, tax intake is going down, so they're getting less money than they've had in previous years, and they're spending more. So it can't carry on, can it? And right, what we've got here, as we've come into this week, having a pretty interesting week last week, is we've got 3 banks that have gone down. Now, you might think to yourself, well, why would a bank collapse? And it's interesting because the latest, which is Silicon Valley Bank, I was listening to something last night. Basically, it's a traditional run on the bank. It's a traditional bank. Some people are taking out more money than the bank's got cash readily on hand to service those requests. It's a standard run on the bank. And of course, as people hear about it, more people want their money, and then you get an acceleration of it. All right, this is just basically standard run on the bank. Now, why they got into this problem is because the reverse of what what banks do, they take out deposits, and literally they do take out deposits, right? and the money's no longer ours; it's theirs. We're an unprotected creditor to the bank, so we're basically giving them our money to do what they want with, and if we're lucky, we get it back. And consequently, what they then do is they give us like a 1% or a 1.5% interest on that, so pretty much nothing. And then what they do is they go out to the market, they buy bonds, they buy treasuries, they buy equities sometimes, and they basically look to get more money back than a higher interest rate than what they're paying out to us. So they're paying out 1%. They're basically investing their money and getting 4%, maybe 4.5%, maybe 5%, and the differential's profit. It's not difficult to understand, is it?
Yeah.
However, what happened is they put all their money out, and Silicon Valley Bank, like 80% of the money that they've got, and we know that these are what they call fractional reserve banks, so they basically can lend more money than they get deposited. So basically what they've done is they've gone out to the market and they basically bought bonds. Now at the time the interest rate was at almost 0, so they're paying out like 0.1% or 0.2%, like not 2%, like 0.2%, like not much, right? Almost 0. And then what they're doing is they're going out to the market, and the bond rate at the time was about 1.5%, 1.8%, something like that. So they were paying out virtually 0, and they were getting 1.8%. Not brilliant, but better than 0, yeah, better than nothing, yeah. And all of that was virtually profit. Now what's happened, having invested all that money and getting this 1.8% or 1.5%, the Federal Reserve over the past year has gone from a 0% to basically 4%, like in a year. So now the bonds are being offered at 5%. So you put your money in, and the short-term yield, like 3 months, 6 months, you can get up to 5% yield on your money, right? So everybody's now investing their money in these. What do you think a bond that's got 1.8%, what the value is? Wait, hang on, why would I buy your bond at 1.8% or 1.5% when I can go out and buy the one directly from the government at 5%?
It's like their goods that they're selling are no longer wanted.
Well, no, because
their investment is like it's irrelevant.
Yeah, so how they get their money back in order to pay depositors who are queuing at the door waiting for their money, they have to sell assets in order to realise the money. But of course, no one wants these bonds.
These are their assets, yeah. Mm-hmm.
They're only 1.5%. It's like who wants a 1.5% bond where there is no likelihood in the next 5 years of the interest rate going down to that level again, maybe even 10 years. So those bonds are basically, if people want them, they're saying, "Do you want my rather poor bond, which I can't pay you what, like." Basically worth 20% probably of what they originally paid for it, which means they're taking a huge loss on realising their money, but they've got to do it because they've got to pay the deposits. They don't want everybody going there saying they can't get their money and shoring up the bank. And basically this is what's happened. They borrowed at low interest rate. They now it's a reverse, isn't it? It's like instead they have to pay out
instead of making profits, they're taking losses.
taking losses, and that's what's caused the problem. Basically, the fundamental problem, and every bank in the world is in the same situation because it's all linked to the global reserve currency, which is the dollar. And
So if that, sorry, Chris, to interrupt. So if that bank, it's probably just because this bank had less overall cushion to be able to go back and lie on it to provide the money that it needs. It was just a smaller size bank with a smaller size.
Well, it was the 18th largest bank in America.
18th. Yeah, so it's one of the smallest banks.
No, it's not. It's one of the biggest. It's one of the biggest banks because there's loads.
But 18th is very. How many banks are there?
Thousands.
Oh, okay. My theory is out of the.
It's not like here where we've got 5 banks and you can't have another one. Over there, they've got regional banks, and basically each of the states has got a number of regional banks. So the 18th is one of the largest banks, and in fact, Silvergate and Silicon Valley Bank and Signature Bank's a New York bank. Now these aren't small banks. These are not small banks. They're basically assisting. They were all assisting the cryptocurrency marketplace. A lot of these were tech company centric, so they were looking after the technology sector. And the problem with the technology sector is going to having the worst time ever. But people are laying off people like Amazon, Google, Microsoft. They're all laying off people, right? So basically, they're not doing that great. And then this comes along, right? And they're quite pro startups as well, these banks, and consequently, that's higher risk. So they were 80% invested in other things like JP Morgan, for example, one of the largest. This is the largest bank, or one of the largest banks, like in the top 1 or 2 or 3. That organisation has got only 60% invested, so they've got a lot more liquidity to settle things. Whereas, Silicon Valley Bank was basically running their bank quite badly, not illegally, but running it quite badly, and consequently that's why it went down. The problem is that, like we know with FTX, and like going back a few months, like November or wherever it was, there can be quite a lot of contagion because people get scared. People say, "Oh, that bank went. What about my bank?" And I go and get some money out, and then that starts to become a little bit of an epidemic, and everybody goes to their banks to take out some cash. And I would say to people, go and get some cash out, have some cash at home, because you don't know, do you? You don't know what's going on, and or less ways, spread your money across different bank accounts, because having it all your eggs in one basket is not a good idea these days. But essentially, we've got Credit Suisse, probably the second largest bank in the world, or definitely the largest bank in Europe. It's maybe next to the European Central Bank. It's a different thing. It's not a central bank. But anyway, they're in trouble. They have a liquidity problem. They're in exactly the same problem. They bought low interest rates and now servicing high interest rate customers, and they have to pay them interest, and it's higher than the interest they're getting. So it's the reversal, basically, of the problem.
What happens when the banks? Everybody runs to the banks to get their cash, or as much of cash as they can. And what happens when the bank collapses? Is that that's it? I'm done. I can't do it.
Well, this is what happened in 2007 and 8, isn't it? It's exactly this problem that the banks basically took all the money. The people basically bailed out the banks, because the government turns around and says, "Oh, we bailed out the banks." Yeah, but what did they bail it out with? They haven't got any money. Governments don't have any money.
They take it from the central banks. They're the local country banks.
No, they take it from us.
Oh,
We're
right.
the only providers of money. We're the only ones that create anything. They're just spending it and calling it theirs. It's not theirs at all. It's our money that they've chosen to spend in this way or that way or whatever. And this is one of the problems.
I don't like this.
No,
I
of course.
really don't like it. It's like we're some milking cows, that we're just
Well,
there doing all the work that we do, and then we are being robbed
there was a law.
day and night.
There's a law passed in 2012 which basically says your money in your bank account isn't your money. It's basic.
I don't like this.
No, I know. Well, no one likes it, do they? To be told that, oh, you know, can I have my money back, please? Why do you want it? You know, like we've got it buried away somewhere else and we're earning money on it. We don't really want to give it to you, so why do you want it? And right, and it's like, hang on, that's my money. Well, actually, no, it's not. You're you know, you're basically supplying the money, and it's not guaranteed that you're going to get it back, especially if we hit hard times. So now the situation is well, how far can this go? How bad can this get? And what are they doing about bailing out this bank? Because they are bailing. Well, no, they're not bailing out the bank, right? And this is the interesting thing, right? What they're saying is that none of the depositors are going to lose any money. Essentially, they're going to all be made whole. That's the word they use.
They're going to be made what?
Made whole. WHOLE. Whole.
Whole,
they're not going to lose any money. None of the depositors are going to lose any money.
What strange use of words again? Whole. Yeah. You're going to be whole. I'm going to be whole. Oh,
so
thank
what,
you.
What so does what's it mean? Happening? So what's happening is the Federal Reserve via the Treasury, which is Janet Yellen, right through the Treasury, they're going to make some loans available to the banks to enable them to service essentially the depositors' shortfall, right? They're basically going to make enough money so that nobody gets caught out, right? Up to $250,000, there's an insurance policy, right? It's okay if this is one or two banks. If it gets a bit contagious, they're not going to be able to manage. But anyway, so the Treasury said, but they're going to lend the money to the bank, not give it to them. Lend the money to the bank, and the bank can then look after the people that would have lost money, right? So that's basically how they're going to deal with it. Now, what happens is that the bank is going to, after 2 years, the government's going to say, can we have that money back, please? Because we only lent it to you. We didn't give it to you. And they're going to say, well, we haven't got it. And so the government's going to let the bank fail. And so that's what's happening with.
But why does it need to be in 2 years? Why not now?
Well, because they're going to put a limit on it. But what they've said is they're going to put 200 billion, I think it is, to one side for this purpose. But it's likely to be 2 trillion that's needed. Right? And where is the Treasury and the Federal Reserve going to get 2 trillion from? The answer is switch on the printing machine.
Yeah.
Now that's quantitative easing. And what does quantitative easing do? It puts inflation up. Right. So you've got the Federal Reserve trying to reduce inflation, and now you've got these problems actually increasing inflation, and there's no way out of it. Right? This is what has to happen. And so you've got these two things fighting each other, and the net effect is either interest rates have to go up to counterbalance this, and then drive inflation down, because the other thing's driving inflation up. It's like there's no answer to it except the banks have to fail at some point. So interestingly, yesterday, when all this started to come out into the papers, because this was all done on Sunday, by the way, the Treasury, the Federal Reserve, and the FDIC all got together and agreed a strategy, right? And that was
on Saturday,
Sunday,
on Sunday, on a work day.
Yeah. And this was every day's work, don't it? If you make it so or not make it so. But anyway, so Monday, this was all published, and interesting what happened in the markets. The markets was, the problem's been averted, and there was a rise in basically crypto, because these are crypto banks, crypto favored banks, right? So, and what happened is that because USDC, which is a stable coin, had money invested in Silicon Valley Bank, 3.3 billion. The price of USDC on Sunday dropped from 1-to-1 with the dollar to just 88 cents on the dollar. So basically, the coin, which is supposed to be on parity with the dollar, lost money. And people started, there was a little bit of contagion there. But anyway, now it's back up to 99 cents or maybe even $1 even. So, and the reason that happened is because the government stepped in and said anybody with deposits here is going to be okay. So basically that meant the USDC losses were insured now for them to get their money back, which meant that there was no risk essentially. So this happened. What happened yesterday was once this news broke, Bitcoin went up like 15% or something. It went up, as did the rest of the crypto market, because the losses were basically removed. And America's been saying they want to ban crypto and all this. They can't really. But anyway, these banks were pro-crypto. You have to ask yourself, well, why did they do this then if it's a pro-crypto bank and we don't like crypto? And, that's another question. I can't answer it, but it's another question, isn't it? So all this stuff going on, and basically all the banks are in the same situation that Silicon Valley Bank was. They borrowed at lower interest rates and basically have higher interest rates they're paying the depositors. And you have to ask yourself, how long can that go on? That's the question. Not just in America, all throughout the world. How long can that situation go on? And of course, if America puts its interest rates up, right, what happens is that people flock to buy dollars because they're getting more return on their money. So they buy dollars, right? And that puts pressure on the dollar price goes up, right? But if you think about it, everybody in the world, in order to buy certain things like oil at the moment, has to possess dollars. And when the dollar price goes up, their currency goes down, which means in their country, inflation's even worse. It applies everywhere because you can't do anything without oil, can you? And you have to buy oil in dollars. So basically, what America's doing by putting the interest rates up is exporting inflation around the world.
And Thank you very much, America. You're exporting wars, now you're exporting also inflation.
And then what happens is those countries have to put their interest rates up, which puts pressure on their banks. So this is not just an American thing. America has stimulated a global financial meltdown by putting interest rates up. But they had to put interest rates up because inflation was coming off. It's
like a big mess, but it seems like this is not what people normally think about. They're so busy working their jobs, trying to keep their households running. And this seems to be too complicated to even begin to consider and begin to open your mind about.
Well, you have to trust the fact, don't you? And this is the biggest issue. You have to trust that all these people in power and in these banks know what they're doing.
But they don't, obviously.
Know what they're doing and look after us.
Yeah, that's the belief. That's the belief that they look after us, but they have no idea what they're doing. They're just trying to protect themselves.
Well, they're trying to maneuver it so they don't lose profits and everything else. In this Silicon Valley Bank, basically the shareholders' price of their shares has gone to zero. So anybody that had put money into that bank's lost it. They've lost it now. So they are going to suffer. But of course, what we know is, and this is over time, is that in order to implement central banking digital currency, you have to get rid of the banks. You have to get rid of them. And whether you believe this is part of that whole project or not is another matter. However, they have to get to that because the only bank that can issue currency in that central bank of digital currency is the central banks, the Federal Reserve, the Bank of England, the European Central Bank. These are the only people that can issue the new money, which is going to be coming, which is digital currency. And all these small banks, the smaller banks, have no place in that environment. So
they're gonna get out of business.
Yeah, but
just like the environment was right for them to appear in business, to set it up when it was all flourishing. Oh, let's make business with borrowing, using people's money to make more money, and just create it out of thin air with mortgages, because that's what happened in 2007-8.
Well, it's a debt-based economy. The only way money is created is through debt. Yeah, that's it. It's a debt world. So when 90%, I think it's 97% of money is created by creating loans, and the biggest loans obviously are mortgages. So this is the way money is created, through debt. And of course it's coming to an end because the system is broken. So
that was a notification for us to wrap it up.
Well, actually, a notification for Otis. Otis has not watched this, but basically has made a decision that banks aren't the best place to have your money. So anyway, that's it. Basically, this isn't financial advice, and there's a lot more to it than what I've just said. And go scour around on the internet, you'll find loads of people talking about this stuff at the moment. But we're gradually getting to the point where banks will be failing. And is this the start? Is this the start of the contagion? Who knows? It might be another 3 months, 6 months before something else happens. But one thing is absolutely true. These things used to be once in a 5 year event. Now they're every 5 hours.
I wonder when Barclays are going to go bust.
Well, the thing is, yesterday all of the banks suffered with massive share price losses. 3%, 5%. This is big money. I mean, we're talking billions here, and you got to say to yourself, if we get a systemic runs, collapses, other banks go, all it's going to do, and they all lend to each other. It's not like these are isolated banks. They've all got their fingers in other people's bank pies, and there's no separating. It's a bit like, if you take a brain and all the synapses, you get one go, and then that obviously affects something else, and then that affects something else, and before you know it, you're down the hospital with a stroke. It's that kind of analogy. And I don't want to be a bringer of doom and gloom. There are ways you can protect yourself. You need to go out and have a look at those things and decide, what's right for you. But you can't do it without information and education. And the vast majority of people do not know this stuff. And I've just put a tiny fraction forward here. But I hope I piqued people's interest enough to maybe go and seek some other guidance, because none of the financial advisors talk about this stuff. They talk about hedge funds, they talk about putting your money into equity, but maybe they've got bonds. None of this stuff's going to do well in the future, which can only mean leaving your money where it is going to lose money. Anyway.
Well, thank you, Chris. It's been quite interesting listening to you.
Yeah, I mean, I'm no expert, really, but I do know a lot more than most people.
You have been researching it for a good number of years, so
I'm interested. That's basically what fuels everything, isn't it?
I am excited to see how Barclays is going to tell me one morning, "Oh, your app is not available."
Your app where you owe us money, you can no longer give it back to us. Oh, damn! What a
perfect. All right, thank you guys for watching. Make sure to subscribe, and see you on another episode.
Bye for now.
Bye.